All right, so if you're shopping for a house, then you need to consider what your closing costs are going to be. It's a huge expense. It's an out-of-pocket expense for you, the buyer, when it comes time to close. And a lot of people know about down payment and understand that they have to come up with a down payment. Very few remember that there is such a thing called closing costs, and it adds to the amount of fees that are involved when buying a house. However, you don't always have to pay them, but even if you get the seller to pay them, we have videos that talk about how to get the seller to cover your closing costs. You need to know what they are, and you need to know how to compare them, especially if you're working with other lenders and you're trying to compare or shop the fees. So that's what we're going to do in this video today. So stay tuned. Well, hey, what's up, everyone? It's Channing, and in today's video, we're breaking down closing costs. What are they? Where do they come from? Who's charging them? But before we jump in, please remember to like and subscribe to the channel so that we can reach more people just like you, and so that you, yes, I'm talking to you, never miss a single video. Without any further ado, let's jump in because I want to talk about closing costs. I think it's very important. It's an overlooked factor. First-time homebuyers especially don't typically shop, and it can cost you thousands of dollars if you do not do this properly. So I'm gonna jump in, and what I want to do is I want to share with you rather a document called the loan estimate. Now, this is a pretty standard mortgage industry document. Let's make sure you can see it. This is a pretty standard mortgage industry document. Oh, you've disappeared. Come back. And what this document does is it shows you everything you're going to pay. And so this isn't a breakdown of your mortgage payment. We have a video that we just did on that. But when you get this loan estimate, you're going to see a few things. You're going to see the date that it was issued, your name, hopefully spelled properly, the property address, the sales price of the home, how long the loan is going to be, if it's a purchase or refinance, which loan program. If it's USDA, it'll be written here, and if your rate is locked or not. So right up front, if you get this and the rate's not locked, then the deal doesn't exist yet. And so it doesn't mean they can't honor it, but until your rate's locked, the market changes, and the rate could change, the fee could change, lots of different things could change until that rate is locked in. So going down, you'll see your purchase price, you'll see your interest rate. Oh man, those are good days. That rate does not currently exist in 2023 when I'm filming this video. You see your monthly principal and interest, and then you see your estimated total monthly payment, which is going to have your principal and interest, your mortgage insurance, and your estimated escrow. So that's going to be property taxes, that's going to be home insurance, all that good stuff. So then you're going to see this big estimated cash to close on this particular sample deal. This is straight from the CFPB's website, $16,054. Now, here's where we're going to spend the bulk of our time today. I find it easier to explain closing costs alongside the form you're going to be seeing when you're trying to compare them. And so that number, 16,054, comes from your down payment and the cost on this second page. Now, one thing that I want you to understand is box A, where it says loan costs. This is the box of fees that you are paying to the lender. If you're using a mortgage broker, if you're using a lender, these are the fees that the loan officer is charging you. Their bank is charging you, that they work for, to do the loan. So if you're trying to shop a mortgage, it's really important that you pay special attention to box A, because out of all of this document, okay, we have B, C, E, F, G, D, all the letters, right? The only box that is controlled by the mortgage lender, typically, unless it's like a builder's lender and they're also forcing you to use their title company, that's a whole other story, is box A. So if you are comparing to another lender and the other lender has a cheaper title fee or a cheaper insurance fee, just ask them if that's a real quote and get the quote, because any lender can use any insurance company and any lender can use any title company. So if they have a lower fee in one of these boxes, then it could just be that they're lowballing it. It could be that maybe they do have a cheaper title company. Whatever the case is, the other lender can use it. What really matters is box A. So let's jump in. Box A, you're going to see origination charges. Now, every lender calls all these different fees something different, and some are clever and some aren't. So you may see underwriting fee and processing fee here. You may see an application fee. I don't typically see a lot of application fees. You may see points, depending on if you have to buy down to get the rate that you want or all those different things. All of these fees, so in this specific example, not too terrible, it's $1,800, right? We have seen these be $4, $5, $6, $7, $8, $9, $10,000 here, and maybe we're three, or maybe we're none. So this is a really important box because this box is telling you what charges you're paying to the lender, and this is the thing you want to shop. Can I get this cheaper, right? So what they don't tell you, and what's not easily known, is that what's in this box can also affect your interest rate. So maybe another lender is at 4.5%, but there's no fees here. And it'd probably be more like 4%. Maybe another lender's at 4%, but there's no fees here. And so if you go here and you just look at the rate and you say, well, they have a better rate, they're the better lender, but then you see the $1,800 in fees, perhaps the other lender can match. Perhaps the other lender could also do 3.875 if they were charging you $1,800. Maybe they could do 3.75. So your interest rate and your origination charges, they go hand in hand. They work together. The more you have in origination charges, typically the lower the rate you're going to see, versus the less you have, typically the higher the rate you're going to see. But not all lenders are created equal. So some lenders just legitimately have lower rates than others, and you'll have a low rate and you'll have no fees. So again, I'm sure that's clear as mud, but that's the importance of shopping, or at least working with a mortgage broker, because at least with a broker, they're going to shop all the different lenders for you and remove that hassle off of your plate. Because who wants to talk to 3 different loan officers to try to figure out who's giving them the best deal? They're all salespeople. Their goal in life is to try to get you to do that loan. That would be frustrating. So anyways, box A is really important. Box A is one of the most important boxes in the entire, I'm going to zoom in a little bit so it's a little easier to see. So box A is one of the most important because that's, if you're shopping a mortgage lender, that's what you need to be shopping. Now, when you move down to these services you can't shop for, the reason you can't shop for them is because the lender's picking them. Okay, they're going to pick who the AMC that gets to order the appraisal. They're going to, they have a credit vendor already set up, so you don't get to say, oh, well, this credit vendor's cheaper, I want to use them. It just not doesn't work that way. So anything in this box is going to be something you can't shop for. It's usually third-party fees that the lender is incurring to process your application, to perform your application. So that's what's going to show up in box B. However, as a broker, if you use a contract processor, which we do, their fee would show up here. So technically, you could call that the broker's fee, but it's not being paid to the broker. It's being paid to a third party, and their job is to make sure that your loan closes on time and they communicate with your underwriter. So that's box B. Box C is going to be your title fees. So these are going to be things like we don't really do surveys in Louisiana, and you don't see pest inspection fees show up here a lot. But you're going to see the title fees. You're going to see settlement fees. You're going to see lender's title insurance. You're going to see title search fees, so on and so forth. So what happens is title fees are subject to tolerance cures. And so lenders will typically overestimate these fees to ensure that they don't have to eat the cost later in the loan. So whatever fees you see here, 9 times out of 10 going to be slightly higher than what they'll be in real life. But that's because if the lender puts a lower amount and then the fees come in different, if it's disclosed with that particular title company's fees, and that's the title company you use, the lender could be on the hook to have to eat that. And they don't want to do that because they're in the business of making money. So, but your title fees, your lender's title insurance, for instance, that isn't something that directly benefits you as the consumer. What it does is it protects the lender in the event that there is an issue with the title policy, there is an issue with the titling of the home, there's an issue with the way that the home was recorded. Maybe they missed someone that owned the home and now they're coming out and they're suing you, right? That the lender's title insurance is going to protect the lender from those types of instances. And it is required on every loan because it is for the lender. When we move over to box E, you're going to see recording fees and other taxes. This is the cost to record the deed at the courthouse. Usually not $85 here, and where I'm at, it's usually about $400. So that's what you're going to see in box E. That's them going down to the courthouse, filing the deed, which is a public record at the courthouse. It's required if you're getting a mortgage. Now, here's the one that a lot of people miss or don't know. So we hear the term closing cost and we think, okay, a bank says, oh, closing cost, that'll be $2,000. Well, what they may not be including, but you still have to pay at the end of the day, is your prepaids. What is a prepaid, Channing? Your prepaids are upfront home insurance premium and prepaid interest charges. So let's talk about homeowners insurance. This only has 6 months. That's incorrect. Again, I pulled this document from the CFPB because I can't pull real world files. That would be a violation of the privacy agreements. But it's going to be 12 months. You're going to see 12 months of homeowners insurance collected every single time if you're purchasing a house. That's something you're going to pay up front. So if that policy is $2,500 a year, which is the case in South Louisiana a lot, $3,000 a year, you're going to pay that up front in your closing costs. So it's going to be here and it'll be $3,000. And that will add to your total amount to close. Now, this is disclosed properly, but let's say that this policy wasn't $600, it was $3,000. Well, this would go up $3,400 or whatever it is. I'm sorry, $2,400. So prepaids are a big deal. Your prepaid interest is also included on here. What is prepaid interest? So when you close on a mortgage, let's say you close on April the 1st. Typically, that mortgage payment is not going to be due until June 1st if you close in the beginning of the month. Now, 30 days is already baked in, but because you are closing and you're skipping a payment, you're not skipping a payment, to be clear. Because you're not making a payment for the first month, you're going to pay the interest charges that are going to accrue from the time that you close on the loan until the time that you make that first payment. And that could be 7 days, it could be 15 days, it could be 29 days. It all depends on what day of the week you close on the loan. So it's really hard to estimate until you know. We put in the closing date of the contract, but sometimes it closes earlier, sometimes it can close later if there are issues. It really just depends. And so prepaid interest is also included in your prepaid charges. Now, if you were comparing rates with another lender and you had two lenders side by side and one lender had less charges in prepaid interest than the other, doesn't matter. It's not something you should shop because at the end of the day, the prepaid interest charges are driven by two things: the day of the week, or the date of the month, rather, that you close on, and your interest rate, right? Your interest rate. So all things being equal, if two lenders have the exact same interest rate, regardless of what one of them discloses, you're going to pay the same amount based on the day of the month that you close. So again, that's not something I would shop because it's going to be the same regardless. So again, we go back to box A. If we're shopping lenders, we really, really want to look at box A for the primary focus of who's got the best rate. And why do I say this? Why am I so passionate about talking about, don't pay so much attention to the title fees? I'm not telling you not to pay attention to the overall number. What I'm saying is there is a lot of smoke and mirrors played by mortgage lenders in this game. And so, I can show that I'm $1,000 less if I just put this for the title company. And guess what? As long as they don't use that title company, there's nothing to prevent them from saying, oh, sorry, that's not the title company we use. Their fees are actually $1,000 more. They don't have to eat that because they didn't disclose the other title company, right? If they put less prepaid interest or less in homeowners insurance, we see this a lot in South Louisiana. We get from banks out of state and they'll put $100 a month in insurance. And that doesn't exist in South Louisiana right now for most people. So there's a lot of games played here to make the bottom line number look good. But at the end of the day, this is why I'm so passionate about this. At the end of the day, box A rules all. Whatever is in box A is what the lender has control of. If it's outside of box A, it matters, but it doesn't matter when comparing lenders. It only matters in making sure that you can afford it. And so don't fall for the smoke and mirrors that are often played. That's what I'll say on that. You go down to box G, and it's part of your escrow account. The lender's going to set up an escrow account 2 to 3 months of your insurance payment, and then your property taxes, at least here in Louisiana, are prorated. So you pay them at the same time every year in December. So you're only going to pay property taxes at closing for the amount of months you're going to live in that house for that year. So if you buy it in June, you're looking at 5 or 6 months. You buy it earlier in the year, maybe looking at 8 or 9 months, just depending on how things shake out. And then finally, you get to the owner's title policy. The owner's title policy does the exact same thing the lender's title policy does, except it does it for you, the owner, and it's passed down to all of your heirs. So as long as that property stays in the family, from generation to generation, you buy this thing one time and you're protected. So we recommend everyone get this, but it is optional, as you can see here. So that's how we get our closing costs. That's how we get to our estimated cash to close. And yes, your estimated cash to close when you're looking at this includes your down payment. So you can see here that there were down payment funds from this particular borrower of $18,000, and there were total closing costs of $8,000. But this particular client put a $10,000 deposit down, and so that makes their cash to close $16,054, right? So it includes it all. When you see estimated cash to close, it includes it all. It can be a bit confusing because if you go up here, you see estimated closing costs, and then you see this number, and you're like, wait, is it both? Is it one? No, it is always estimated cash to close. That is your total amount that you should be prepared to bring to the closing table, of course, if it's accurate, if it's right? So some lenders, they don't get quotes. They don't get insurance quotes. They don't get property tax quotes. They don't get quotes from the title company. They just have a generic number that's stuck on everything. They send that to you. It looks great. And then the next thing you know, your payment jumps up $200 a month. Your closing jump up $2,000 to $3,000 out of pocket. And you're like, what the heck happened? And they go, oh, sorry, the insurance quote came back more, or the property taxes were more, or the title company was more, right? So always make sure that whoever you're working with is giving you real world numbers. I don't know why anyone would not want to do this. Even as a loan officer, other than trying to be deceptive, you're just setting yourself up for failure, because at some point they have to come back to you and tell you that they need more money from you than they told you they were going to need. And that just blows my mind. Like, why would anyone do that? But I digress. So guys, that has been a review of closing costs and what they are, from the exact worksheet you're going to get when you close on a home. So if you have any questions about this, y'all know I'm here, ready to help, ready to give advice, ready to answer any and all questions you have about closing costs or mortgages or anything. And if you need any help and you live in Louisiana, there are links in the description and in our About section. We would love to help you. For everyone else, including those in Louisiana, please like and subscribe. It really makes an impact with YouTube and the algorithm, and we want to help you.